Welcome to a video that I like to call the deep dive video, and I need to explain this a little bit. Every week I do a number of videos, specifically a video each day. So I go through hundreds of daily charts. Well, I don't use all of those charts in the daily videos. And so what I do at the end of the week, the last video for each week, is I go through all of the daily charts and some additional charts and put them together in this video. And I call it deep dive because we're looking at charts that may not be really speaking loudly right now. We kind of have to look more under the surface to see if we can get some any insights from these charts. And often that can be quite helpful. This is being prepared for Monday, January 29th. The first chart is a chart of the VIX, although the VIX is invisible on this chart. What you see is a 50-period exponential moving average of the VIX. We usually use static numbers with the VIX, 12 to the downside and 20 to the upside. We put a moving average on top of that to give us what is the general range over a period of time. And this goes all the way back to about 2004, so we can get a real big picture look at this chart. Well, you can see that there are times when we don't stay in that 12 to 20 range. We go up and we set a higher range. Then other times we come back down and set a lower range. After the COVID plunge, we set a higher range again. And now we could be in the process of setting a lower range again. We just have to see this played out. We don't really use this to make any decisions, but we just want to be aware of what's happening in the market. Another chart is how fast is the VIX moving. Now, the VIX goes in the opposite direction of stocks. So when stocks are going up, the VIX has a tendency to go down and vice versa. Right now, we're getting about a reading in the middle of the range, but sometimes we can see when the VIX is really going up fast, we'll get a high reading when we look at an RSI based on 9 periods. When it's really going down quickly, we will get a low reading. And quite often that can be one of the things that we can use to signal that maybe the market is looking at a turning point or at least is exhausted in that particular move. And we have a study on top is called the MOVE Index, and that measures the volatility of bonds. The next chart down is the VIX, which measures the volatility of stocks. The next area down is just the spread between the two. That's the green line. The red line is the S&P 500. The chart, or the part of the chart that I follow the most, is in the bottom area here. This is the correlation between the MOVE Index and the VIX. Right now, they're just about neutral. Sometimes we get a really highly correlated relationship, meaning they're going in the same direction, which can be either up or down. Or if we get a really low reading, that means they're tending to go in opposite directions of each other. When it's just about in the middle like it is now, we're not really getting any insight from the chart. We also do a study of the VIX to the S&P 500 and then take a correlation. And that's what you see in the middle area here. Sometimes when we get a high reading and it comes down, that can quite often signal that maybe the market is getting ready to decline. Right now, we're getting not necessarily an extreme reading. We watch this. I look at this chart every day, but right now it's not really giving us any insight. Then we look at the VIX and then a 3-month average of the VIX. It has been declining. That's typically positive for the market. As we started 2024 with some pressure on stocks, we've been seeing this going back up. If we continue to go up with the stock market itself, we would probably see this ratio start to go down. We just want to be aware of this for right now. We also look at the VIX and then take an average of the VVIX, which measures the volatility of the VIX. When this is going down, that tends to be positive. And right now, as we've hit a little bit of problems in the early part of 2024, this is starting to go sideways and is actually going up just a little bit. Again, if we're going to turn more positive on the market, we want to see this continue to decline. We do keep an eye on this. If this starts to really become apparent, then I'll actually start using it in the daily videos. Another chart that I used to show this in the daily videos all the time, and it's when we were going through these changes. This is a 253 period moving average of the equity put call ratio. When this is going up, that tends to be pressure for the stock market. When this is going down, that tends to give it support. We have been going down as the market was showing a lot of improvement, but lately this has been ticking back up. Since it's based on 253 periods, it can take a long time for this to shift, and it's still picking up the earlier weakness that we saw in 2024. Then we look at a ratio between the VIX and the MOVE index. When this is going up, that just means that stocks are more volatile than bonds. When this is going down, that means bonds are more volatile than stocks. Even though the market is looking a little tired right now and it's setting new all-time highs, there's not a lot of enthusiasm at the current time. And so it's a little surprising to see this going up. But when we compare it to bonds, they're actually even more comatose right now, even though interest rates have been going back up. Then we look at another fear gauge. This tends to go down when the market is going up. Well, lately we've been chopping more or less sideways, so I haven't been showing this chart as much. This is another fear gauge that we look at. As this is going down, that means that fear is decreasing. And as the market has been going up, we are seeing this ratio continue to go down. Then we look at a ratio between risk on and risk off. And I used to show this chart every day because it can really move at some times, but we were entering the last part of 2023 with this going up as the market was going up, and now we're just kind of chopping around. We might have a couple of down days, a couple of up days, and it hasn't been really insightful lately. Now, if that changes, I'll start showing it again in the daily video. This is a chart that I never show other than in this video. For a long time, I was trying to measure how far below are we from the all-time high. Well, since we're setting new all-time highs now, we're now 1.5% above the previous all-time high. This is just for information. Then we look at the NYSE, where the S&P, it's a big index with over 500 stocks, but the NYSE is even bigger. So that can give us more of a broad market measure of what's going on. We take a cumulative measure of the NYSE advanced decline line. When this is going up, that's positive. When this is going down, that's negative. And we're not really showing any kind of real move right now. On the bottom, we just have a regular NYSE advanced decline line, which is going back up, which is positive, but it hasn't gone past this previous high. Then we use another measure. Even though this is also an NYSE advanced decline line, it's calculated in a little different way, but it's kind of showing what we saw on the previous chart, where it is going back up now, but hasn't surpassed the high set back in 2023. Then we look at common stock. And on the top, we look at the price, and that has been going up. And then on the bottom, we look at common stock based on the volume. And we're seeing a little bit of a negative divergence here, where we've been going back up based on price. And if you try to compare down below, we've been going back up based on volume, but we're not going up as fast. We still have further to go to get back to this previous high than we do with price. Not a real big thing right now, but we have been noticing this for a little while. I'm also noticing this in some other indicators that I've been bringing out in the daily videos. Then we look at the NYSE advanced decline line, which is the red line here. That's the broad market measure. And then we have the S&P 500, a little more narrow measure. That's the bar chart that you see, and we can just compare them. And then I have some moving averages here. And when this is measuring the general trend of the NYSE advanced decline line, not the S&P 500. And recently, as we started into 2024, we are seeing a golden cross here, meaning that the NYSE advanced decline line is going up, but we did see some weakness to start the year, and now it's starting to show some improvement. Then we have some technical alerts, and these are put out by stockcharts.com. These are automatically generated. What you see here is for the entire week that we just finished. You start this by reading at the bottom. This was in Monday's session, and when most of them are green or blue, that means they're positive. When they're red, that's negative. And then we go all the way throughout the week. And looking at this in total, you can see that most of these are blue or green. And I say blue or green because it looks a little different depending on what you're using to watch this video. And when we see more green and blue, that's positive. When it's more red, that's negative. Then stockcharts.com also has the ability to give technical scores, not only for individual stocks, but also for indexes. And the 5 main indexes that I follow are the S&P 500, naturally. That's kind of the backbone of everything that I do. We also follow the Dow and the NASDAQ 100, and we follow the mid caps as well as the small caps. And then we can take the charts as they look right now, and stockcharts.com can rate them on a score of 0 being the lowest, all the way up to 100 being the highest. And then I rank them from top to bottom. So coming in first place are the QQQs, which is the NASDAQ 100. They're coming in at 94.6. We can also see how this score has changed over a period of time. We did see some weakness earlier in January, and now We've been setting a series of new all-time highs with the NASDAQ 100. Coming in second place is the S&P 500. Also saw some weakness to begin the year, has been showing some improvement, and it comes in at 86.2. In third place is the Dow. These are represented by the diamonds, which is the ETF for the Dow. And this is coming in with a score of 84. Then in fourth place are the mid caps, which we're seeing some real strength as we were finishing up 2023. And then they've been under some pressure now in 2024 so far. And their score is currently 53.3. And then in last place, which was looking really good in December, we were getting up into the 90s. These are the small caps, as represented by the IWM, which is the Russell 2000 small cap ETF. As we saw a lot of selling going into small caps, we saw their technical score go way down. We actually got down to about the 20 level. We are seeing some improvement now, but we're still coming in quite low and in last place at 39.4. Some short-term charts. This is a short-term rainbow, and I try to look at all of this chart together to get a big picture of the short term. And when price is above all of the colored lines here, that means that we're in a solid uptrend, and that's what we're showing right now. Then we also take a double and triple exponential moving average study based on 20 periods, and that creates a green line and a blue line, and prices above both, and we're continuing to go up. When we were having some trouble earlier in the year, I was showing this chart quite a bit as we were breaking below these lines. Now that we're coming back above them, it's more confirming the uptrend. Then I was also really looking at the 20-period moving averages, and I plot both a simple moving average and an exponential moving average on this chart. When we're above that, based on price, that is quite positive. When we see the green line starting to go above the red line, that's also positive because the blue line, because the blue line is an exponential moving average and it moves faster than the red line, which is a simple moving average. And that just means that we're going up quicker. And so that just means there's more strength behind the upward move. Intermediate term, we have another rainbow going from 50 periods up to 100 periods, and we're above all of the lines here in the rainbow and looking positive in the intermediate term. Here's the same basic principle with the double and triple exponential moving average. Instead of being based on 20 periods, this is based on 50, and we're coming back up to the red line and we're hugging that, and this tends to move quicker. So that just shows that there's more upward thrust for right now. When the red line is above the blue line here, that also means that we're going up quicker. So the intermediate term trend is strong compared to this. We also look at what's called an anchored moving average, where most moving averages, you start calculating them from today and then go back 20, 50, 200 periods. Well, the anchored moving average allows you to go back to a point in time and then extend that moving average going forward. This creates what's called an anchored moving average. And last October, when we were running into some problems, we actually dipped down below this red line. Since we've been bouncing back up, we're far away from that line, so I haven't been showing this chart. We also have a Connors RSI, which is another momentum oscillator, which we can also use to give us overbought or oversold indications. We're not getting anything extreme positive or negative right now, and we've actually dropped a little bit below the midpoint. So it's just a little bit negative for the time being. Then we look at a 50-period moving average. Also, I plot a simple and exponential moving average. And the blue line has been above. That's the exponential moving average. But we're seeing it slow down just a little bit as the red line's getting a little bit closer. The simple moving average does tend to move a little bit slower. This could also point to some more intermediate term exhaustion. We're also quite overbought in the intermediate term right now, and so we've been watching that closely. But for looking just at this chart, we are positive because price is above both and both are continuing to go up. Then we also plot a 100-period moving average, both a simple and exponential moving average. And this one does have the red line going up. That's the exponential moving average. It's going up faster than the green line. Price is above both. So our more intermediate to longer term trend is positive. Then we measure how far above or below are we from the 200-period simple moving average, and we're well above that currently. Then this is standard deviation. This doesn't measure direction. It measures speed based on 10 periods. And we're starting to pick up a little bit. As the S&P has been going up, the standard deviation, or how fast this is going, has been picking up as well. The mass index is not generating a signal right now. We only pay attention to this when it gets up to the red dashed line and the blue line. If that ends up happening at some point, then I'll explain what we use this chart to see. Then we look at the S&P 500 on top and the S&P 100 on the bottom. And we just want to get an idea. Are they moving in the same general direction? Are we seeing any divergences here? We were getting a little concerned as we were finishing out 2023, where the S&P 500 was actually outperforming the S&P 100, but they're coming back more in line now, and we're seeing the S&P 100 actually perform a bit better. Then these are just some measurements. We went from the previous all-time high, then to the October 2022 low. And then as we were going back up, we hit the July 31st, 2023 high. And then we started to run into some problems. We hit a low back in October. And then this is how we've been coming up on a measurement basis since that time. Then the Bollinger Bands. I did show this chart earlier in the week. This measures if we go either above or below one of the Bollinger Bands, and we spend a very short period of time above or below any particular band. We did close up outside of it. That's when we're getting a %B reading that's extreme positive. Now, as price has been chopping a little bit more sideways, the %B indicator has been coming down. The fact that we're above the midpoint does mean that this is positive. Then the point and figure chart, we did have an X drawn earlier in the week, but not one after Friday. So that's why you see all of the black X's here. Since we did go back and create a new all-time high for the S&P, we created a new X, and then after that, we created another X. So this is looking quite positive. Point and figure charts don't take time into account. They just wait for price action to occur, whether that takes an hour or a year. And then when that trigger comes out, then either an X is drawn if we're going up or an O is drawn if we're going down. This is the Pring bottom fisher, which is going down right now. This is really a helpful indicator when we've been really going down with the market, and it looks like we might be getting near a bottom. Since we've been going up, this chart really hasn't been helpful. A long-term chart also shows another long-term rainbow, which this should be a long-term rainbow instead of intermediate term. Just trust me in the fact that we're looking more positive and the lines are even a little further away from price. This is a special K oscillator. This is a long-term oscillator. I mentioned this in many of the daily videos, but I don't show it because we don't get very many signals from this chart. We crossed over positive back in November, and we've been positive ever since. Then we're looking at an arithmetic scale. Most of the charts that I've shown up to this point, in fact, all of them, are based on a log scale. If you switch one of the little buttons on your charting software, you can go over to an arithmetic scale. And then just for kicks, a while back, I drew a trend line going back to 2009, and we were starting to bump into this. This was acting as overhead resistance. We finally broke through it, then came back down. Now we're starting to get far away from it, so I haven't been showing this chart. Here's the long-term rainbow. Oh, it's elusive. So if you trusted the fact that I said we're going up and the lines are going up, then you trusted me the right way. This is the NASDAQ 100, also on a log scale going back to 2009, and we're above this longer-term trend line. I do show these charts from time to time. This is kind of a critical area, and the folks that are more perma-bears, they're always just sure things are going to fall apart, and it's just around the corner. They're watching this chart thinking, uh-oh, we're going to hit this, and everything's going to fall apart. And that might happen, but it's not happening now. In fact, we're actually starting to break above this longer-term trend line. Then we look at a ratio between the NASDAQ 100 and the Dow, and this is getting kind of interesting here. We're getting pretty close to the point where we're coming back on a ratio basis where we were when we were going up with the dot-com boom and then the dot-com bust after that. We also matched that same level in 2021, right before we ran into problems with the market. We're getting close to that point again. Doesn't necessarily mean things are going to fall apart, but we want to know about this anyway. And if this starts to really act up, I will be showing this in any videos necessary. Then we look at the weekly chart of the S&P on top. We have the German DAX weekly chart in the middle area. That's the biggest stock market in Germany. And then we see that the correlation between the two it had become quite weak. Now it's getting quite strong. Now, they both could be going up or down, but they're having a tendency right now to go in the same general direction. Sometimes we can get some early warnings from what's happening in Europe. Then we look at the 10-year yield in the U.S., and we subtract the German 10-year yield. And because U.S. rates are higher, that gives us a positive answer. When we're above this red line, that means it's positive. And then what's interesting about this is we can plot the US dollar index down below. Now, it's not helping us right now, but there have been times when the correlation has been really strong between the upper chart and the middle chart. Right now, there's not a real strong correlation. In fact, they're more neutral to each other. So this chart really hasn't been very helpful. Then some support and resistance levels. I don't have any Fibonacci charts because we're setting new all-time highs, and we have to just wait for things to play out until we can look at some other support or resistance as far as Fibonacci is concerned. This is a chart that I developed decades ago, and I developed it for a trading system that I used. I stopped doing the trading system, but I kept the indicator. Very simply, this is a 20-period simple moving average of the open, high, low, and close. When we're going up and then we fall back, a lot of times one of these lines will act as support. When we're going down and we bounce, a lot of times one of these lines will end up acting as resistance. We're far above all the lines in this little mini rainbow is what I call it. So I haven't been showing this chart. Then we have a 50-day cycle. This seemed to work out pretty well in 2023. It's uncertain because there are different days of cycles that you can put in there, and you kind of have to do it by trial and error to figure out which one is working. We did start a new cycle on January 2nd, and it looked like we were going down, but now we've been starting to go back up. We'll just keep an eye on this to see if it's helpful, because there were times when it marked the bottom, other times when it marked the top, other times when it just meant a continuation of what was already happening. Then here is a Fibonacci study on the NASDAQ, because it has not gone back and set a new all-time high yet. It's looking pretty good, but it still has a ways to go to set that new all-time high. This is an Ichimoku cloud. Sometimes you might call it an itchy and scratchy cloud, where a lot of folks use this, especially in the Forex markets, when really all this is a set of moving averages that are then shifted forward. And when we're going up and then we fall back, sometimes this will act as support. When we're going down and we bounce, sometimes this will act as resistance. I don't use this exclusively, but sometimes we can get some insight from this. And when we see the cloud turn from red to green, that's also more positive. Some broad market measures. This is the financial sector, which has been doing quite well lately. This is the support level that we had been watching as we were coming back down. We're far away from that, so I haven't been showing this chart. Then we look at the Vixen on top. This is a bar chart and has these icicle things falling off here. We can also show the line chart down below, and this is just suggesting that fear is very low for the NASDAQ 100. Then we do a ratio, or I have the S&P on top and then the Qs to diamonds in the middle area. And then I look at a correlation between the two, and the Q to diamond ratio is pretty strong. So if the NASDAQ 100 is going up, typically the Dow is also going up, and vice versa. Here's the bank ETF. And we did have a real problem almost a year ago. That was in March when the banking crisis hit, and then we went sideways. Now we're starting to see some improvement, but we're kind of chopping more or less sideways. But we did start to go in an uptrend with the bank ETF. And we're keeping an eye on this because back in the great financial crisis, things got bad, and then they got better for a while, and then they got bad again. And so we just want to keep an eye on this. Is there something still more to come as far as the banking crisis or the financial sector? So that's why we watch those particular areas. Here is the regional banking ETF, and then we do a ratio with the financial sector where the regional banks are showing some improvement. We came back down to the 50-period moving average, and we've been bouncing back up since that time. Then some rate of change charts. These are just for information. We look at Friday's close and go back 250 trading periods, where this is pretty much flattening out right now. Here's a longer term look at that same chart. Doesn't really help us all that much. It's more positive if it's going up. Then we keep an eye on bonds. This is the S&P 1500, which is a broader range of the market. And we compare that with shorter term bonds based on 1 to 3 years. This is showing that stocks are outperforming bonds. Then we look at the 1 to 3 year bond ETF, and we compare it with further out bonds. And this is a little bit of a concern. And a week ago, I did a new video called What to Watch, and I brought this chart up in that video, and I may do it again. When this is going up, that means that interest rates are rising, okay? And then we hit a bottom in October, and interest rates started to come down, and this just meant, maybe the Fed's done raising interest rates, so we can party, we can look at a lower interest rate environment. But look at what has been happening now, especially as we start into 2024. This is going back up. That just means that 1 year shorter term rates are climbing faster than longer term rates. Then here's an inverse also showing 7 to 10 year bonds. When this is going down, that just means that interest rates are continuing to go up. That's a little bit of a concern right now. And then on top, in blue, we have the long-term bond ETF. That's the TLT. In red is the S&P. And we look at the long-term correlation between the two. That's based on 50 periods, and it's coming down a little bit, but their long-term relationship is still pretty much intact. But if you just look at the chart, the red line's going up as the blue line's going down. You can see their shorter-term relationship. They're having a tendency to go in opposite directions from each other as the market is trying to adjust. Okay, are interest rates going to go up? Are they going to go down? Are bond prices? Are stock? Blah, blah. And that's part of the uncertainty that the market is dealing with right now. Then we look at the correlation between the Qs, which are in black, and the TLT, the long-term bond ETF. And they had a pretty strong correlated relationship, but that's starting to show a little bit of weakness. Then here are the yield curves, where the most important ones are the 10 to the 2 and the 10 to the 3 month. When they're below these red lines, that means they remain inverted, and they are still inverted. When this is going down, that just means that stocks are underperforming bonds. Then here is cash, or as we measure using the 1 to 3 month T-bill, and we compare it with further out bonds. The fact that this is starting to go back up is a little bit of a concern. In a more positive interest rate environment, we would like to see this continue to go down. Then this is looking at TIPS, which are Treasury inflation protected securities. When this is going down, that means that the market isn't as worried about inflation, but we're starting to see this go back up again when we look at TIPS versus further out bonds. We want to watch this. If this continues to go up, that could cause some problems for stocks. Then I have a thing called the possible positive scenarios, and these were really developed for when we're really going down and it looks like we could be establishing a bottom. But when the market's going up, we can still find some use in these charts. The first one here are the percent of stocks in the S&P 500 above their 200-day simple moving average. When we're above the midpoint and going up, that's positive. We had been pulling back, but over the last week, as the S&P has been going up, we've been seeing some improvements in this chart. Then we do that same basic principle, the same idea, but we look at a 50-period moving average study for the S&P. We are showing some improvement. Now, at the end of 2023, we had become extreme positive. We can use this like an oscillator, and then it fell back, and now it's starting to show some improvement. We can take that same measure by looking at the mid caps, where we became extreme positive, fell back, showing some improvement. And then small caps, extreme positive, fell back, and now showing some improvement. And then this is a 19-day exponential moving average of the advanced decliner ratio. I show this off and on, especially when we're crossing above or below the zero line and when we get extreme positive or negative. The fact that we're crossing back above zero based on price and volume is showing that this chart is more positive. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you're having a wonderful weekend, and I will talk to you in the next video.